And what we're going to be talking about today is what we do at our firm on valuing early companies, venture companies, hyper growth companies, companies where the traditional metrics of using PE ratios and those types of things that are most common to investors out there really don't fit into it. Hey guys, I'm Rob Luna. Welcome to a special edition of Wealth Talk. I've got my man here, Luis Galdamez. Everybody knows that it takes a team to do good work. Luis has got 18 years experience in the industry, degree in economics, certified financial planner, chartered financial analyst. He's the guy who helps make me look smart, leads my analytics team. So this all came about from some work I've been doing with some early stage companies where I went out to the public and said, we're going to be able to give you some information on how you can do this yourself. This was normally something we were planning to do for my Academy members paid, but we wanted to live up to our promise. And I'm excited today to share with you what is really some proprietary information, a model that we've built through years and years of experience, a lot of education, and it's really worked out very well for us. And I think what's really important as part of Wealth Talk, why I started to do this, is to really educate the public on being able to make smart financial decisions themselves. When I look at chat boards out there, I look at Twitter, Instagram, and how people are, let's say, valuing stocks, it's absolutely ridiculous. It's not fundamental. It's not even technical. It's really based off of fear. It's based off of emotion and a lot of guesswork. So what we're here to do today is give you guys the specific framework, step by step, of how we go through some of the quantitative metrics, meaning looking at management, branding, things of that nature, their ability to execute. But what we're also going to do, I think extremely important, is give you the quantitative analytics that we use to actually set price targets on companies. Luis is going to walk you through some of that work we do. And what we're also going to do is make available on our website a download of that actual spreadsheet. So when you go out there to analyze maybe some of the companies you own in your portfolio now, or if you're looking to analyze future companies to see, should this be a good investment for me? We're going to give you that actual tool that we use to help you determine the price. So let's go ahead, Luis, and jump into our presentation for everybody. So as we mentioned, early stage company evaluation framework, that's what we're looking at today. This is my framework that I built through 24 years of experience now. I built this from a few different things. Number one, in creating a company myself, I was trying to get to a point where I could really understand the marketplace for my wealth management firm of how do I create and build a business that has enterprise value? What is the market willing to pay for it? And so out of necessity, I had to really understand how business valuations were made. I have 24 years of experience basically in the wealth management space. I've worked with a lot of entrepreneurs. I work with startup companies. I consult to publicly traded companies, CEOs, corporate level executives on really how to value their business. I deal with businesses who are just at the idea stage. Just this year, I've launched 2 new businesses myself where we've got multiple multi-million-dollar valuations on 2 businesses, one which is actually pre-revenue. So when you start thinking about things like that, how do I value a company that doesn't even have any revenue? And there is an appropriate way to do it. I'm going to take you through our 10-step process, first starting out on more of the quantitative metrics of what we're looking at. And then we're going to get into that spreadsheet that I talked about that Luis is going to walk you step by step on how we're doing it. We're even going to take a current publicly traded company and show you how we're looking at that in the marketplace to really give you an idea how to bring that all home. So let's jump into the framework. First of all, when you're looking at early stage companies that are just getting ready to go public or just starting out at the idea stage, really is where I look at a lot of them, is you have to look at the opportunity set, right? You hear about TAM, the total addressable market. How large is that market? So for example, if you're looking at a company that everybody knows like Netflix, if you look at how many people are in the world, how many people are in the US, well, if you look at the US, for example, and you break that population down to households, people that could actually afford Netflix as a service. That gets you to somewhere, let's say you take 400 million people down to 100 million people. Well, that would be the opportunity set, for example, saying you have 100 million potential subscribers in the US. Now, what's the ability to be able to convert those? And if we're able to convert all those, what are our margins? So if we're charging $15 per month and we get 100,000 people, 100 million people to be able to subscribe to that, is that a large enough investment opportunity for me? So then you might look at things like globally. Okay, well, if Netflix can now go to India, where there's over 1.2 billion people, if they could go to China, where there's over 1.2 billion people, they can go through Europe. You see that total addressable market starts to expand. And the idea now becomes real to me, where if you're looking at some very minuscule total addressable market, where it's a product and it's a need that really isn't that large, and maybe you're only going to capture 20 to 30,000 people at most, that's probably not something that's going to get you too excited. Remember, when you're investing in early stage startup companies, what's the idea? We're investing for hyper growth. We want big, huge potential opportunity. Obviously, there's a lot of risk in that, but we're not necessarily looking at companies that are going to be paying a dividend in the first year or 2 years, are going to be growing at 10 to 20% a year. We're looking for hyper growth opportunities. So number one, you want to make sure that that opportunity set, the total addressable market, is quantifiable, addressable, and large enough. Number two, human capital. So this is something I spend a tremendous amount of time with. As someone, I sit on an investment committee along with Luis, other analysts on our committee. Really where I come into play is on this quantitative side. I want to understand who are the people that are now going to be executing on this opportunity set. So we know the opportunity set may be large. We might have a really great idea that we're going to be able to fulfill a need in the marketplace. But important, very, very important at this early stage is who are the people that are going to be executing. So let's just stick with Netflix, for example. What I would be looking for first and foremost at the top is a CEO that has prior media experience, who is taking companies from an early stage to latter stages, or who's potentially maybe come around to a business and turned that business around and has executed on that in the past, right? So if I'm looking at just sticking with that Netflix theme, maybe is it someone who had some experience at Disney before or Time Warner, somebody in that area that has executable experience that I'm able to actually confirm that they've done this before. Have they been successful within that industry, right? The most important thing I think also about the CEO, when I'm looking at CEOs of these companies, are they visionaries? Are they able to motivate and inspire people to work long hours? Sometimes when you get an early stage company, people are actually working for free. A lot of them are coming in because of the fact they're getting equity. And the hope is, yeah, I'll take a pay cut now, but in the future, because we're going to do some well, that equity is going to be extremely valuable. So they're willing to defer earnings a lot of the times because they believe in the vision, the mission of the company, but importantly, the CEO's ability to lead. So also when you talk about human capital, it starts with the CEO, but it's everybody that's executing in every single space, from technology to marketing to finance. You want to make sure that this is a well-tested, well-rounded company with identifiable, verifiable experience. And at this early stage, in every industry that I'm dealing with right now, technology, media, finance, healthcare, everybody is competing for talent. There's a talent shortage out there. So is this a company, is this a CEO that has a big enough story, big enough total addressable market? They're going to be able to go out and recruit the right people to be able to execute. So that's our 1 and 2. We've got a huge opportunity. We've got the right people to execute. And then what we're going to do from there is start getting into number 3, which is our branding and audience building. So branding is very, very important in the marketplace, especially for early stage companies. Why do companies spend hundreds of thousands of dollars just on a simple logo, millions of dollars on branding and advertising? Is because people, when you're out there competing, You're competing in a sea of noise. It's so easy to launch a business and get it to the marketplace today, to where if you're a media company, technology company, healthcare company, how do you stand out and look different? How do you build an ecosystem? What I always talk about is the Apple effect. Is this a company that is going to be able to build that Apple effect where there's people that are just huge proponents singing the praises of this company? Even though we all know, a lot of us have these iPhones, they might not be the best product out there. Arguably, a lot of the guys that are heavy into tech tell me that the Android is definitely a superior product. But we all know why we use the iPhone, because I can call up and FaceTime my daughter on her iPhone. It's tied into our music. It's tied into our photos. They've got us tied into an ecosystem where we love it. It's created a brand. People have identified with that Apple brand. Tesla is another company where there's huge proponents of Tesla. They love, they breathe Tesla. Disney. When you think about these brands, when I say Disney, Tesla, Apple, Nike, something comes to mind right away. Logos, people, feelings. Is this a company that's going to be able to build a brand and an audience? If you cannot do that today, I throw that out of the marketplace. Number 4, now that we've got the right market, we've got the right people, we're building a brand, it's time to start seeing if we can execute. So we look for current milestones, we look for obstacles, depending on what the stage is. Now, if this is a pre-revenue company, we're going to be setting up strategic objectives that are identifiable. We're going to be launching X on this date. By this date, X is going to produce this much revenue. By D date, we're going to have this. Those are milestones, right, that a company needs to be setting out for you. Again, early stage companies who haven't launched yet, that's going to be on paper. Now, if it's a little bit latter stage, well, you're probably going to have a quarter, 2 quarters, 3 quarters, maybe a year or 2 years of actual data. And so what I always look at those companies, so what did they say 18 months ago? And then I'm able to actually look at the track record of how much have they executed on during that time period. So if it's a company that's meeting and or exceeding expectations of what they've set out, well, that gives me a lot of confidence in their ability to continue to do that in the future. The corollary is if they're missing even small milestones, they're way ahead on what their budget was, they're not getting the type of traction in their marketplace that they were, that might be a time where I decide, hey, I'm not going to invest in this company. Or it could even be when we talk about risk management is something important in these companies as well. Do I cut my losses at a certain period of time? Do I reduce my position because what I thought was going to happen, what management articulated was going to happen, either the marketplace is not receiving well, management is not receiving well, but these are the measuring sticks that we should be looking at. If it's a publicly traded company, how do we look at that? We're following their quarterly earnings calls. We're getting on those earnings reports where management is telling us what they did for the previous quarter. A lot of times they're articulating, providing revenue guidance for what's going to happen in the forward quarter. If you were an owner of a publicly traded company, that is an early stage company, that is a hyper growth company, you need to be on each and every one of those single calls so that you're able to grab data. Later on in this presentation, I'm going to show you how we're taking that data, then putting it into a framework to create price targets, just like analysts are doing, but I would arguably say much, much better than what they're doing. Number 5, product viability, right? So we're looking at these milestones. Product viability is how is this product that we're putting out into the marketplace, if it's an early stage pre-revenue, how do we believe it's going to be able to survive and compete? But actually, once we get going, what is that adoption rate? A lot of times also, companies have several pillars of different products that are in the marketplace. So we need to be able to pivot. We might go to market with 4 products. We might then realize product viability is really just 2 products. So what you do on paper, what you do kind of in the planning zone, once you get out there to execute may be completely different. This goes back to having the right management in place to be able to use that risk management to pivot if necessary, put more revenue towards the products that are doing well, potentially cut out the products that are not doing well. But also over time, we know that things evolve, right? We talked about Netflix, so let's stay with that theme. What happened to Blockbuster? Do you think they could not have taken those same DVDs that they were renting to us in store and started mailing them to us, just like Netflix did at the beginning? They absolutely could have. Could they have then gone to the cloud like Netflix and gone to a subscription as a service model? Absolutely. You look at companies like Kodak, who should have owned the digital camera marketplace. They just did not adapt. They didn't pivot enough, either because they weren't innovative enough, they didn't have the right culture. More than likely, they did not have the right human capital that we talked about early. Now, when we talked about number 6, proprietary technology, patents, what type of power is behind this that's going to establish dominance? So that's one of the things today. It's so easy to create a business. You have things in retail like Shopify, where I could set up a store and resell somebody else's product in a bat of an eye. So many big technology companies today are doing white labeled service, where I could take just about anything, put my logo on it, and go out to market. The problem is, unless you have something proprietary that nobody else is able to do, or unless you have some type of dominance in an area that's very hard to replicate, that makes your barrier to enter very low. So when you look at things like patents, when you look at things like a scale. So for example, if I want to come to marketplace today, you and I want to put a computer company together, maybe we can put 5 to 10 computers out a week, and maybe we could charge an ultra high price point. We might have the ability to build a computer, but do we have the scale to be able to compete with Lenovo or Dell or Mac? More than likely not. So when we're talking about this power, patents, technology, scale, size, what's establishing us as a dominant leader? Let's think about Boeing, for example. Maybe we could put together a 747. Are we going to be able to compete with Boeing? Probably not. So when you think about dominance and power and contracts and those types of things, think, how is this company like Boeing? How is it a company that nobody else is going to be able to come in just 2 to 3 days, put out a business? There's a lot of companies with good ideas that are executing, but they're very, very susceptible to being disrupted because they don't have that proprietary, power, patent, technology. Structure. So when you start thinking now more along the lines of, what does my investment in company A, B, or C look like? Whether that's private company, public company, you want to understand what that structure is. How favorable or non-favorable is it to you as a shareholder? One of the things we're looking at in the marketplace today is the Chinese companies, the ADRs, really getting beat up. Why? One of the reasons is that structure. It's not extremely shareholder friendly. You're not, in the case of a company like Alibaba, even really owning shares directly in that company. They're setting up offshore Cayman Islands types of structures where you're owning a structure of a structure that has a tie to that equity. So when you start thinking about that, there's a lot of regulatory things that could come into place that could hurt that. You might not have any voter or ownership rights whatsoever. It may be a structure so favorable to the company or organization that they can wind you down and still go on well. Think about a company like General Motors, not exactly the same thing, but what happened to General Motors that a lot of people don't understand. General Motors stock still trades today. However, common shareholders during the Great Recession were absolutely wiped out. They were taken down to zero. Preferred shareholders, okay. Bond holders, okay. But even though they launched a new stock, if you had 10,000 shares of General Motors when it was wiped out, that new stock came into the marketplace, you had absolutely zero. Just an idea of getting you to understand, where are you in the capital structure? What type of voting rights do you have? What is your liquidity? Are you locked up? Is it a situation where you could be easily diluted through the company? These are all things that you need to ask yourself. Importantly, make sure that you're comfortable. And when you do your analysis to see what's worst case scenario, and as a former risk analyst, I'm always looking at what's worst case scenario. What could happen to you as a shareholder if the worst thing happens, based off of how they're articulating the shareholder structure to you? Another important thing that I always look at in any private investment that I invest a lot in the private space, but also public, is who is my fellow shareholder? What's their liquidity needs? What's their level of education? Are they long-term shareholders? Are they short-term shareholders? Ideally, when I invest in something, I want my own interest to be in line with fellow shareholders. If not, we're going to get a competing interest, right? We're going to have conflicts of interest. If somebody's looking to flip something in the short run, and I'm understanding that I'm identifying with this company over the long run, that is going to be a challenge, whether it's a public or private company. If it's public, there's going to be a lot of pressure on the sell side, obviously, on that company of people who are exiting early. Even worse, if it's a private company, people might need liquidity events. So they're trying to go and sell the shares off market, wherever the place may be. So make sure when you look at the structure, it's shareholder friendly. Importantly, most important thing, make sure you thoroughly understand what that structure is. So I would then kind of piggyback into the existing share structure and dilution, really kind of one and the same, where structure, I'm really worried more about the shareholders. I'm worried more about liquidity, but shareholder structure and dilution, this is something I really want to understand in a sense of total shares that are available. What happens if those shares are converted? What does that mean to voting rights? I'm going to be worried in terms of where is this company at its current stage, right? So when I'm investing in early stage companies, I might go into a company with, let's call it a $25 million valuation, and I make a $2.5 million investment to it. Well, I've got a 10% allocation to that, and this is great. But if I know that they are going to need millions and millions more in capital, ultimately, I'm going to be diluted. And I want to make sure a lot of times in these private investments, there's clauses in there that are anti-dilutionary, that'll come to me first to allow me to level up my shares. You just really want to understand that in the private market, but also in the public market. When we talk about total shares, what's definitely going to be converted, what may be converted, and you'll see in a little while why that becomes important to share price. Because what is share price? It's basically number of shares outstanding based off of current price, and that current price is going to be indicative of valuation. So the more shares that become available based on the same amount of earnings, the lower the valuation in stock. You get that? So if you've got 100 shares that are earning $1, that's more valuable than having 1,000 shares that are owning $1. So the larger that float gets based off of that $1 in earnings, the less valuable it's going to be. So as a shareholder, you just want to be able to understand that. So jumping into number 9, projections. So projections. As I mentioned, I just started a new startup company myself that has a multi-million-dollar valuation pre-revenue, right? So pre-revenue, investors are investing in that company purely based off of what the projections are. They're going to continue to put money based off of whether or not we hit those projections. They're going to pull money based off of if we miss those projections. So for early stage companies, you need to make sure you have management that is transparent, that is putting out benchmarks, that's putting out projections that make sense. And what you want to do with those projections, we're going to show you in a minute, is take those and put those into a financial model where you're able to determine based off of projections. And this is where I always go to with early stage companies. I always go to when I can get on a call with a publicly traded company and ask management a question, venture capitalists. I'm always going to get as much information as possible. Now, it's very tough, especially when companies become larger, more successful. They get very tight-lipped about projections. Why? Because companies, especially public companies, are usually judged quarter over quarter whether or not they meet those projections. So they want to do one or two things. Number one is maybe sandbag, they call those projections, where they lower estimates, keep estimates low to where they think they can artificially beat those. Or there's just some companies that are so successful, they say, we're not going to give forward guidance. But as an early stage company, which is what we're talking about here, I will not invest with a company that is not giving me that guidance. Because if you're not giving me that guidance, you're definitely not giving me earnings. You're not giving me a dividend. How am I able to determine what a fair valuation for what I'm investing in? And so if it's pre-revenue company, I'm investing 100% in everything we talked about: total addressable market, management's ability to execute, what are our patents and technology. I don't have anything other than idea and what you're telling me you can do. So those projections are how I'm going to base my investment. Those projections, quarter over quarter, year over year, are going to be everything I need to know about whether or not I stick with this company or I exit out for the company. Finally, what I'll talk about in terms of early stage companies, importantly, financing to build big, bodacious ideas, to build big, scalable, multi-billion-dollar businesses is very, very expensive. I think the person who showed us this very, very early on in the public markets was none other than Jeff Bezos, who's today launching rockets to space. He started out in the mid-90s with an idea to revolutionize and change the world, which came public as essentially a book company. And you look at that company, and a lot of people, and I've been a shareholder for well over a decade of Amazon, tried to use traditional financial metrics to value Amazon. So they were looking at dividend discount ratios, price to earnings ratios, and said, hey, this company is just a book company. It's not cheap enough. It's way too expensive for us to invest in. Yet that stock continued to double, quadruple, and people who put as little as $10,000 at the beginning are worth several millions of dollars today. Why? Because there were people who believed in the company. There were people who continued to buy the shares. And ultimately, what happened is the public markets for Amazon in the late 90s provided the financing necessary to ultimately dominate just about every space they're in today. They wouldn't have in the 90s been able to do that as a private company, which is why they went public. Now, I'll tell you today, though, when I started in the market in the 90s, there was almost 5,000 stocks. Today, there's about 40% less than that. Why? The private markets are so big today. There's so much liquidity. There's a lot of sophisticated investors that realize to get in with an early stage company, most of those companies today are private. So in the private markets, companies are becoming what they say unicorns, achieving those billion-dollar valuations without that need to go public for capital. But keep in mind, and don't be mistaken, financing for early stage companies is one of the key components to whether or not they're going to succeed. Why? Just go back to step one, right? We have to have the right management. We have to have the right ideas. We have to have the right structure in place. We need to have the right market. We need to have the right brand to be able to execute. But what do we need? To pay those people to work for us. We need to be able to pay to build proprietary technology. We need to be able to pay to put marketing out in the place. And a lot of times over the early years, why can't you use price to earnings ratios? Because there is no earnings. Just like Amazon for several years had no earnings. Did that make you a valueless company? Well, yes, if you use the traditional framework, it showed that you were valueless, but we know that Amazon now is a $1 trillion company plus early on was extremely valuable. However, without that money to be able to do that, so if you're a private company, early investors, seed capital, series A, B, C, D, as you get public, people continuing to support the share price. Why? Because a lot of M&A, for example, you'll see these companies growing organically, inorganically, is being done through shares. Also, if you're going out to recruit talent, that's being done through shares. So money, share price, all those things are going to be very, very pertinent at the early stage. If companies are not able to raise money, if they're not able to sustain a high enough stock price, they will fail. The best people in the world with the best ideas without the capital to execute will not be able to execute. So this is a lot of the overall metrics step by step to where you should be looking at any company you're investing in early stage through this framework. You should be confident in 1 through 10 that these companies are checking all those boxes. If not, we do not invest in those companies. Now, Here's where I'm going to bring in Luis to bring it all together. Now that we have all this, and this is everything that I do first as a qualitative analyst, is making sure that we check all these 10 boxes. If we don't check all these 10 boxes, it never makes it to the desk of the rest of my investment committee. But let's suppose now we found a company that checks all these boxes. How much are we going to pay for it? How much are we willing to pay? What's the management we should be looking at? How much money should we be putting into it? What are those things looking like? So this is something I teach in my academy. We talk about investor frameworks. We talk about where this fits in. So the part we're talking about right now is up in that speculator part of the portfolio, especially when you're talking about new companies, pre-revenue companies. If you look at one of the leading private equity firms out there who I spent some time with on Sand Hill Road in Silicon Valley, you can Google them, Andreessen Horowitz, one of the best early stage investors out of there. They're investing of hundreds of companies at the same time. Why? Because they know some are going to be grand slams, some are going to be home runs, some are going to be doubles, some are going to be singles, and a lot are going to strike out because of the fact high risk, high reward. We put the allocation up there in the speculator part. Now, this is a general framework. Obviously, you have to do your own due diligence, talk to your financial advisor, depending on how young you are, your propensity for risk. Maybe you're erring 10% on either side. So either you're not in or you're up to 20%. But remember, these are the investments that you're making that have a high potential of loss, but a high potential of extreme gain as well. So when you talk about how much, we're saying on the high end, if you're someone very, young and you're willing to take a lot of risk, maybe that 10 stretches out to 20%. There's kind of a rule of thumb in the industry within that 20%, never to invest more than 5% in any one company. I think that's a pretty good rule, right? Because when you look at years like this, your portfolio might do 10, 15, 20%. If you had 5% in an idea that went to zero, no big deal. You're able to make that up within a year, maybe 2 years at most. But if you're allocating 25, 30, 40% of your portfolio to any one stock, and I don't know any stock out there that would get that much of my capital, even something like Warren Buffett's Berkshire Hathaway, which really isn't an individual stock, I would not make that big of an investment because it goes back when you invest to also being a risk manager. And as a risk manager, how I started my career, as I mentioned, I need to understand first and foremost that any dollar I invest in any company, Enron showed us that, Blockbuster showed us that, Circuit City showed us that, Bed Bath & Beyond has showed us, company after company after company that's gone bankrupt. We know no matter how much we believe in the product or service, that can go to zero. A 5% allocation is doing a lot of the risk management for you, especially in early stage companies, right? They're going to be volatile. There's going to be a lot of headwinds and noise around there. And your confidence is going to be much higher if you have a position size that you can lay your head down on the pillow at night and sleep with. However, if you're very worried or nervous about losing that money, if you have too much allocated into it, you're going to be susceptible to making emotional decisions, and you're probably going to sell that stock at the absolute wrong time. So that's the 10-step framework. What we're going to do now is get you into our spreadsheet. We're going to make this, again, available to you on our website via download. The information will be put up here of what you need to do to go to our website to register. We're going to actually give you this spreadsheet to use. The nice thing about it, I'll let Luis explain in terms of how we're able to get all this data for you. That's going to be free. We wanted to give you something to take away to where now that you have this information, how you could actually use it and act like an analyst yourself and make more informed investment decisions about potential stocks you're looking to invest in, or even some of the stocks that are in your own portfolio.
Great. So as you said, Rob, what I'm going to be showing you is the number side of things, right? So if we take a step back, when you analyze a security, you have to look at the qualitative and quantitative aspects of the stock. We just looked at the qualitative, which is what Rob does best, talking about strategy, talking about what management's doing based on his framework, what he expects the company to do. So that's the qualitative, the narrative, the story, but that has to be married with the numbers. The numbers have to reflect the strategy itself. I've seen time and time again, analysts and investors that are just getting started either focus just on the numbers, they pull up a spreadsheet, punch numbers in, and then get an expected stock price or a return for security without paying zero attention to the story, the narrative, the qualitative part of it. And you can't do that. I've seen the other side too, where people tell a story and the story makes sense, but they don't realize if the stock is priced correctly. Because you have to remember, a good company is not necessarily a good stock. They're very different. It could be a good company with the good narrative, but if the stock has been bid up so high, it's no longer a good investment. Or the other way around, if the stock is somewhat shaky, but it's gotten beat up so much, then perhaps maybe you do want to take a gamble with it with a very small portion of the portfolio. So again, you have to look at the two and they all come together. So what we're going to show you here is a framework. And the framework, as Rob says, it's better than us just telling you what we think of any one security, because that's just going to be very stagnant. It's going to be at one point in time. And as you know, the markets are very dynamic. So we want to give you a tool where you can go in here and at any point you can go and punch in numbers and find out from you by yourself what these securities are actually valued at, right? So we're going to show you here this great framework and how to value early stage companies. So companies that don't have any earnings, companies that maybe just turned a profit, because as Rob said, you cannot use traditional frameworks. A price to earnings ratio that is very commonly used, you cannot use because there is no earnings, or if the company just turned a profit, the data is not there. It's not long enough. There's not enough history for you to make any use of it. So what do? The market turns to looking at revenue. Revenue is something that you can forecast based on the strategy. So if Rob looks at the company, he looks at the total addressable market, he makes some assumptions about management, he thinks management can deliver, and he says, okay, right now, they could probably go from a 1% market share up to a 5% over the next 12 to 24 months. And here's why. Then that story plays into the numbers, and that revenue growth then translates into the spreadsheet, which gives you an output and telling you how attractive or how not attractive the security is. So what we're going to look at is what's called a price to sales ratio. And the price to sales ratio is very simple. All it says is how much are you willing to pay for $1 worth of sales. The higher the multiple, the higher the ratio, the more you're willing to pay for that dollar worth of sales. The lower the ratio, the less you're willing to pay. Now, normally the way you look at ratio analysis is that you compare it to the company, their historical. So if it's been trading at a price to sales ratio of, and I'm making this up, 20, and now it's trading at 15, well, now you know the market's paying less than they were for that dollar worth of sales. Now you can also compare two companies. Say you have company A and company B. Company A has a price to sales ratio of 20 and company B has a price to sales ratio of 10. Well, a couple of things you can infer. Assuming the same sales, company A is being priced twice as much. Now you might say, well, why would I want to pay twice as much? Well, more likely than not, because that company is growing a lot faster, company A, than company B. And it all comes down to the narrative. Perhaps company A has a better story, and going through the 10-step framework, you realize company A has a lot more potential because it has the right management, has the right structure, it has the means to be able to raise the capital to reinvest and grow it better than company B. So you're willing to pay up for it. So we're going to focus on that price to sales in this framework. And I'm going to show you, we're going to give you the spreadsheet, how you can go in there and update it whenever you want. So in this example, we're going to use Riot. So Riot, for everyone, basically it's a newer company. It had negative earnings per share. It just turned a profit this year. But again, not a lot of history. So using traditional metrics is not going to get you very far. And Riot is a company that mines Bitcoin, and that's how they make their money. All right, so let's look at Riot. And what we've done here is, if you look at the spreadsheet, anything with this color, gold color, it's a variable that you can change. So Riot, for example, you type in the ticker RIOT, and then it's formulated inside of Excel to tell you the name of the company, the industry it's in, where it last traded, which in this case, it closed at $37.72. It was up 0.25% for the day. It traded 12.3 million shares. Then some basic metrics. It's gone as high as $79.50 over the last 52 weeks. and it's been as low as $2.35. So a big wide margin where it's traded. And finally, the market cap, which right now is 3.6 million, which is in essence what the company's valued. And then we pull the average daily volume, which is 10.6 million. And then finally, the shares outstanding, which is 95.9 million for the company. So this is automatically going to pre-populate. I'll give you a quick example here. If I wanted to do coin, for example, I could punch in coin, hit enter, and then in just a moment, it's going to update here. And so on the right-hand side, you should see that I'm going to select coin. I'm going to select it, and then it's going to pre-populate that information. So now it last traded at 256. It tells me that it was down about 1% on the day, and it's got a lot of the great information. So I'm going to go back to Riot because that's the example that we're going to show you. So typed in Riot, and boom, there it is. The information is given to you. Now, we did an analysis. We went back and we looked at companies that had an IPO over the last 3 years that traded on the NASDAQ. And what we did is we categorized those companies that had an IPO over the last 3 years based on their revenue growth at the time of IPO over the last 12 months. So if a company had revenue growth of 100% versus a company that had revenue growth of 50%, well, the company that had the higher revenue growth got put in its own quintile. And actually, we broke it down into decile. So what we did is we broke it up, and there were about 360 companies inside of this, broke it up into those deciles, and we showed the companies that grew the most during their IPO over the last 12 months. The market was rewarding them with a price to sales multiple of 24.4. And they were growing on average of 199% was the median company inside of this group. If we looked at the mid decile, so the 50th percentile, you see that they were growing only at 27%. And to no surprise, the price to sales was 5.72. So the market's not going to reward these companies if they're not growing very quickly. So it's very, if you take a look, very logical, right? So the higher the price to sales, it's because of the higher growth. Now, what's interesting is when you look at the bottom decile, the bottom decile had an actual negative growth of 19% from the time of IPO, but people were willing to pay 29.2 times, which is even greater than the top decile. So you might think to yourself, that doesn't make any sense. Well, actually it does. The market, what they were doing, investors were willing to pay up for a narrative, for a story. So even though the company did not necessarily have a good revenue growth, the story was there, and the market was willing to take a bet on these type of securities. As Rob said, one of the businesses that we're working on doesn't have any revenue yet, and he was able to get a very attractive valuation. Well, it's because of the narrative, the story, and people are willing to pay up for his expertise, for his ability to deliver. And we see that in the market as well. So if the company doesn't have big earnings or big revenue growth, they could still be, people are still willing to pay up for it if the narrative is there. The reason why we're showing these deciles is in just a second here, I'm going to open up these hidden cells. And we're going to go through an example. We're going to go through an example using Riot. And the variables that you're going to put in here are the price to sales multiple, the number of shares, and the growth rate that you're going to assume. Now, what we're going to do in the price to sales multiple, I'm going to give it a 16 price to sales multiple in here. And it's a variable. You can do whatever you want, but I want to anchor you to what the top companies are doing. So you don't want to go in there and put 100 or 120. It won't make any sense. The number of shares is pre-populated directly from the data in this box. However, if you remember the framework, when you're in an early stage company, a lot of people work for free, or they're working under the assumption that they're going to get stock options, or some type of security that converts to common. If that's the case, you want to go in here and manually calculate what the diluted share is, punch that in here, because that's going to be very important to the valuation. And then finally, you're going to get here the 50th percentile or 50% growth rate. Say after we do the 10-step framework, I think the base case is 50%. I'm going to plug that in. And I think that the year-end sales for Riot is going to be 209 million by the end of the year. By the way, this I got from FactSet. So FactSet has analysts, and I took that directly. But if you don't have access to FactSet or Bloomberg, you can pull up the company's financials. You can look at what they did last year, and then apply a growth rate to that as well, or based on the story, the narrative, you can put your own number. After that, everything's formulated, right? So for the base case, I put in 16 for the price to sales multiple. The number of shares I'm going to leave alone. I'm going to assume a 50% year-over-year growth rate for the next few years. And I'm expecting a 2021 year-end growth sales of 209 million. Now, from there, it's going to grow at 50%. So 2022, it's very simple, 50% of the 2021 numbers. And what it tells me here is the calculations, right? So based on 2022 numbers, I'm showing that Riot should be priced at about $52.35. Right now, it's about $37.72. That's just telling me that if they can hit this number and the market continues to apply a multiple of 16, that's what it would be worth. Now, if you go 2023, again, it grows by 50%. And based on the same price to sales multiple, it would be worth $78, 2024, 2025. You see the trend here in the base case. Now, I will tell you with the price to sales ratio, normally you're looking at roughly 12 months. It's just too hard to forecast what accurate numbers would be for a company. So I would say probably want to be looking at 2022 year-end numbers to give you a pretty good idea, right? But we want to look at scenario analysis. So now we want to take it a step further because no one really knows what the company is going to do. So what I'm going to do is look at a worst case scenario. I'm going to say, in my worst case scenario, the market is going to say, look, Riot's not going to grow as quickly, and they're going to decrease their price to sales multiple from my base case 16 down to 12. I'm going to keep the same number of shares, but now the company's only going to grow 25% per year. And it still starts the projected 2021 numbers of 209 million, but now it's only growing by 25% year over year. And you see, if that were the case, based on 2022 end year numbers, Riot should be priced at $32.72 in this scenario. We're finally going to move over to the best case. In the best case, I'm going to assume the price to sales multiple, the market's going to think, look, Riot's delivering, they have the right management, they're beating what they're saying. I'm going to give them a 20 price to sales multiple, same number of shares, and now it's growing at 80%. So if you take a look at 22 numbers, now it's worth $78.53. So depending on what you assume, the company is going to be, it's going to have a different price target based on the implied price to sales and the number of shares. So which one is right? Well, here's the thing, no one knows, right? But what we want to do is give you a framework. So once you create your base case, your worst case, and your best case, your job is to look and make sure management is delivering. When they give you, if they give you guidance, look where it falls within this box. Once they give you actual numbers, how is it trending? Is it trending more towards a worst case? Are they beating? Maybe it's trending more towards the best case, or maybe it's your base case. Depending on how that number comes out, you're going to know where your company is, and you can always update it, which is why we made these cells here dynamic, because, you know, markets are dynamic. And with this framework, you'll be able to get a very good idea of what the company should be priced based on the price to sales multiple. Now, this is our first iteration to this. We're going to make this a little bit more sophisticated. We wanted to first give you a very basic foundation. And then what we'll do is give you the ability to say, perhaps for the first couple of years, the market's going to give it a price to sales at 16, but over time, as the company slows down, it's going to decrease the price to sales multiple. And you'll be able to say, instead of 50% year over year until 2025, perhaps for the first 2 or 3 years, it grows at that. And then it starts to level off, which traditionally what happens with early stage companies. They get a lot of strong growth at the beginning, and then it starts to level off. So we'll make it more sophisticated for you. But I think this is going to give you a good idea of how to start looking at these type of companies.
Yeah, it's great job, Luis. I think there's a lot of things that have been said here. I mean, first, I kind of want to reiterate, this is not a crystal ball. So those of you guys looking for shortcuts to just plug something in and justify a price target, that's not what this is. You know, this is an educational meeting to give you guys some background and ideas of what we do to actually put price targets on companies. But I think a lot of you are going to find out from going through this presentation who maybe don't have traditional financial experience or maybe newer to the markets, this is more than likely a lot more robust of a framework and scenario that we put each company through than many of you have been going through. But this is exactly, guys, what gives you conviction in the investments you make. So it's almost laughable sometimes when I get onto social media and I see price targets that people are putting on stocks. Why? Because I've done this homework. So that's like someone coming in and saying, oh, Riot next year is going to be at $220 a share. Why is that laughable? Because even in our best case scenario, we're predicting that stock to be several years from now, it's not going to be valued. And that's what most people are doing, is they're going off of emotion, they're going off of idea, or they're going off and saying, hey, with Riot was $72, it should be worth 70. Well, you can see, why is it not at 70 anymore? In our framework, we showed it probably wouldn't get there if everything went well for a couple of years from now. So when you're doing this type of analysis, when you're putting sophistication, where you're putting actual metrics, when you're looking at companies, just like a competitor might be looking at how much am I going to pay to take over this company? When you're looking at companies as a sophisticated investor would, in a framework where that we're now giving to you, there's no reason you should be taking shortcuts anymore. So, as we mentioned at the beginning, we're going to be putting this on our website, this spreadsheet for you guys to download. You can play around with different things, educate yourself, please. That's what this is here for, you to start making more educated investment decisions. And obviously, what are the variables? Those variables are going to change quarter to quarter as the marketplace changes. What is the market willing to pay? We're talking about price to sales today being X, but if interest rates go up, for example, people aren't going to want to pay so much. You're going to have to adjust that back down, right? In terms of what numbers are we forecasting for revenues? Ideally, we're taking what the company tells us, because if the company tells us something, that's specifically what we're looking for. Or we might, as Luis said, have to look at what are some of the analysts putting out in terms of expectations. Or a lot of times what we're doing ourselves is that guesswork to say, okay, if you're Netflix and we think you can get 1 million households this first year at $14.95, well, then we now have our own revenue number. But this is why everything should be very forecasted, very calculated, and good investing is done just like this. It's not emotional. And so this is why I created our academy that Luis and I are on every Tuesday with people, is walking people through this. When do prices change? When do price to sales ratios change? You need to be an educated investor, partner with people who are thinking different. Again, this is a different way of thinking versus PE ratios or things like that. That's not what you apply to these types of companies. So whatever the company is you're interested in, you now have a very specific framework to plug in. And we even gave you, for early stage companies, what are some of the metrics in terms of price to sales you can use there. The main thing that you need now is to understand quantitatively, do they have the management? Is it the right product? All those things we talked about, the ability to execute. And then finally, what do you think that revenue number is going to be? Then you're going to start to get realistic expectations and a narrative in which you're making investment decisions off of. And how do you know? One of the toughest things as an investor is when to sell. And a lot of times, hopefully you're selling at a profit, but sometimes you have to sell at a loss. And the only way you know how to do that outside of emotion is to have this framework and narrative, so you're able to tell day by day, month by month, year by year, is the thesis in which I'm investing in this company still valid? Are they meeting and or exceeding expectations? Do I need to cut my losses? Do I need to put more money in? Do I need to stay the course? This is how we made fundamental decisions for over 2 decades, that you can now start making decisions in the same way. So I know this was longer than our 10 to 15 minute usual wealth talk, but we want to provide an abundance of free information for people out there. Please, if you like this, share it with a friend, subscribe to our YouTube channel, go to our website, sign up for this spreadsheet. We'll send it out to you. You'll be able to use this free of charge. Check out our academy, robluna.com. We appreciate you guys. Have a great weekend.